Go ahead. Hello. I'll let you go. I'm sorry.
Okay, well, we off to a great start today.
Yeah,
My name is Ira, folks, and that's James Gillespie. That's been known as the mortgage doctor. So, having said that, I'm gonna shut up and let the mortgage doctor introduce himself. Go ahead, James.
hello, I'm James Gillespie, the mortgage doctor, working over at Gill Mortgage Company. I'm a loan officer over there, and good evening to everyone this evening. What I want to do is go over a few things today and talk about the mortgage process in regards to purchasing a home. So I want to start out with that and see if this will be a benefit for everyone, which I'm sure it will be. But what I want to start with, and like I had mentioned earlier on your show, Ira, we talk about credit, which is one of the main things we have to start out with to determine if we can get a client approved for a loan. So what I'm starting out with is the fact that we talk about credit. Credit, one of the things about credit I talk about is bad credit history. Well, how can I explain? Let me start out with this. I got 5 financial benefits of owning a home in regards to credit and how it's a benefit. Homeowner, I'm going to read a couple of things. It says home ownership is a great investment which comes with many benefits. And there are 5 different financial benefits of owning a property. Okay? First of all, you earn equity. Once you purchase a house, value of property start appreciating over the years, and obviously you're making monthly payments on your mortgage, which eventually builds up equity into the property. So that's always a plus. So again, number 2 is appreciating home value, which I just said. So you got the out of the 5 benefits, the first one is earned equity, and the second one obviously is appreciating in home value. And then you also have as a third great investment for purchasing a house is financial security. You know, once you own the property, you now have some security in regards to leaving investment property to your next generation of kids or family. So that's a benefit. So you can have some lifelong generated investment, which is the property. So again, financial security is always a plus in regards to benefiting, having a benefit to own a property. The fourth thing, most predictable, is possibly a lower housing cost. Sometimes when you buying a house, the mortgage payment is less than renting a property, renting an apartment or what have you. So a lot of times people think, well, if I buy a property, it's going to be more expensive, and that's really not the case. Sometimes the mortgage is obviously less than your rent that you're paying each month. Okay, so that's another benefit. And then the 5th benefit of owning a property is the fact that you have a tax break. The interest that you pay on your mortgage each month, you can write that off at tax time. So that could be a benefit during taxes where you're trying to write off enough debt where you don't have to wind up paying the IRS back as much money because you're writing off equity or the interest from your mortgage payment each month. So those are 5 financial benefits of owning a home. And then as I continue to go here, and Ira, if you have any questions, stop me if you have any questions.
Well, Gina, you have one, okay?
Yes,
one of the things, okay, that when you speak of buying a home, okay, the word equity always pop up. What does equity mean?
Okay, equity, great question. I started to break that down, but I'm glad you asked. Mm-hmm. Okay, let me give you a breakdown of equity, and I'm trying to make it simple where everyone that understands it. Equity, for example, let's say you purchase a house for 100,000. I'm going to do even numbers. Let's say you purchase a house for 100,000. If you bring in, I mean, let's say you purchase for 100 and your balance now is 50,000. Okay? If your balance is now 50,000 and your property is worth 100, value is worth 100, then you're sitting on $50,000 worth of equity. So that means if you decide to sell your property or refinance the property, what happens is there's $50,000 worth of equity in the property because you bought it for 100. Now your balance is at 50, and it's actually valued at 100,000. I'm just throwing even numbers though to make it easy.
Okay, I got you. Okay.
So again, if your property is worth 100 and you have a balance of 50,000, you're sitting on $50,000 worth of equity. It's basically the money value of the property, of interest in the property in excess of claims or any types of liens against it. So if you got a lien for 50,000, balance for 50,000, the difference again is $50,000 worth of equity. Okay, I hope that was separate.
Well, in a way you were okay, but and I guess when I asked the question, it seemed as though you're saying that I have money in the bank for the most part.
Right. Well, it's not really in the bank; it's in the equity of the property. So again, if you own a property for 100, say the value your property is worth 100,000, and you only owe 50,000. The difference of 150 is obviously 50. So that means you're sitting on $50,000 worth of equity. If you had a balance of $25,000 on your property and it's really worth 100, you're sitting on $75,000 worth of equity. So that means if you ever want to refinance or pull cash out of your property, typically the guidelines is that they'll let you pull up if you need some extra cash, they'll let you pull up to 80% of the value of the property. So that means if it's $100,000 value and you owe 50 and you want to borrow $30,000 out of your property, they'll loan you up to 80%. 80% of 100 is 80,000, and then you subtract that 50 from the 80,000. And that's the equity they'll give you out of your property. It's $30,000. So, yeah. So, does that make sense to you?
Yeah, it did. Like I say, like I said, really, it's a benefit to you that you have that you didn't have before. In that something that you can always, it's a benefit to you that you actually get.
Right. And if you say you sold the property, if you sell the property, then you getting 100%. You sell it for 100, you owe 50, you're walking away with 50. You sell it for 100 and you owe 25, you're walking away with $75,000. So,
or you can say, James, that when you buy the house, $100,000, keep that same number, and in a couple of years, the value is going to go up.
It's going to appreciate.
Appreciate, right?
Yeah, typically these properties are appreciating right now, and that's a plus. So if you bought it, say 5 years ago at 100, it may be now worth 150. And if you owe $50,000 on it, now you're sitting on $100,000 worth of equity that you could borrow up to 80% of the value of the property. Or if you sell it, then you'll be able to get your total 100,000 if it's valued at 150 and you only owe 50. You walk away with 100 if you sold the property. So basically, equity is property, is the value, the money you have difference from the lien on the property. And again, if you didn't have a balance at all, let's say you didn't have a balance at all, let's say it was paid off, property is paid off, and it's worth 150 or 100,000. So if it's 100, that means now you're sitting on $100,000 worth of equity. So the difference that's the difference between the balance and how much the house is really worth is based on the equity in the property. Okay, it's the money value of the property or interest in the property. So Did you follow me on that one?
I got you.
I hope I explained that well for everybody to understand it. And then I was one thing I wanted to continue on. I got a script of different things that I go over here. I got why home ownership? Why would you want to do it? It says again, you earn equity. You just mentioned that you earn equity in your property. That's why people want to have a ownership of a property as opposed to renting. Because if you're renting, obviously you're not getting any money you're not building any equity because you don't own it. But the reason why you want to have ownership is to build equity, like you just said. If you've been there a few years, 5 or 10 years, your property now is appreciating more, and you get an opportunity to have more equity built up in your property. And then again, like I stated earlier, it's a financial security. Your home equity belongs to you and can be a savings cushion for the future. You could use that money, that equity, as a cushion for the future, for preparing to retire, what have you. Once you build that equity up, having ownership. And I got here predictable lower housing. Here's another thing when I talk about renting or buying. Your rent is controlled by your landlord, but you can set your mortgage payment to not change over time, except for taxes and insurance. A lot of times people are getting fixed rates, which is good, as opposed to getting a adjustable rate mortgage. And so if your rate changes, if your payment changes on your mortgage, it's not based on the interest rate. It's based on the fact that your homeowner's insurance is included in your monthly payment and your taxes. So that means if your homeowner's insurance goes up, let's say homeowners was $1,500 a year, now it's $1,800 a year, then that could cause your payment to go up. And then the same thing about taxes. Taxes could go up as well. Once the property does appreciate, which is a good thing, your taxes have a tendency to go up as well, which causes your monthly payment to go up. So on the FHA loan and most conventional loans, most people put the escrows in. Escrows are taxes, homeowners insurance, that type of thing. And whenever taxes or homeowners insurance increases, it could cause your payment to go up. But you're on a fixed rate, which doesn't change. The interest rate doesn't change. It's just the fact that taxes or homeowners insurance could go up. And most recently, homeowners has been going up based on the market, and also value has been going up. So taxes have been increasing. I've been getting a few calls from different buyers stating, "Hey, James, my payment went up. What happened here?" And when I look at it, I can tell that taxes went up, homeowners possibly went up, but the interest rate stayed the same. So that value, the value. Once the value goes up, the taxes increases typically. Okay, and usually mortgage companies, what they do, beginning of the year, they send out what they call a escrow analysis. And when mortgage companies send out an escrow analysis, typically around January, February, sometime beginning part of the year, it'll say, "Hey, we did an escrow analysis on your property, and we noticed that your taxes went up," because taxes in the St. Louis area is always due December 31st, okay, of each year. And so they send that out at the end of the year, beginning of the year, and they'll tell you, "Well, your payment's going up because your taxes went up." Now, homeowner insurance could be due any time of the year. All depends on what month that you closed on or bought the property. If you bought the property in August, like it is today, this month, you'll pay the adjustment if it goes up, or even if it goes down. Sometimes it may go down. If it goes down, your payment will drop as well. But beginning of the year, the mortgage company sends out an escrow analysis and give you a breakdown of taxes went up, homeowners insurance went up, and this is what your payment is. Now, again, if it drops, if taxes go down, the homeowners go down, which I've seen in the past, but not recently, your payment drops. But more than anything, you got to remember you're on a fixed rate in which never changes, but taxes and homeowners could. Okay. And then I mentioned to you guys earlier that, by having a mortgage, the mortgage interest and the real estate taxes may provide income as a tax benefit. So you can write off taxes, well, interest for sure. I've never been able in my past. I haven't been able to write off taxes at tax time. Yeah, but interest you can write off. You can't write off real estate taxes at tax time. I think in the past you could, but I've never had that opportunity. I think that's been a while back.
I think that changes by the state that you live in, I think.
Yeah, something like, I'm not sure. It may be by the state, but you can only write off interest on the property as opposed to real estate taxes. And a few other things I want to go over: buying and renting, buying versus renting. Okay, again, the freedom of buying, you have the freedom of not buying, you have a landlord restriction. Okay, if you're renting, obviously there's a landlord restriction. Maintenance depends on the landlord. You got to wait for the landlord to come by and fix what have you. But then if you own the property, you could do whatever you want. You could paint, you could do any kind of new construction on the property, add a room, or whatever you want to do, as opposed to a landlord telling you the things you could do because you're renting. Okay, but if you own the property, you can paint, you can do whatever, you could do any upgrades or repairs, whatever you would like to do by owning a property. You open your home to whomever you like. I know sometimes when you rent, landlords say, oh, you can't have any pets. So, just different things. So it's a benefit of having a property because now it's yours and you could do whatever you like to maintain the property or do whatever you prefer. And then I'm going to get back to this equity again. When you're renting, obviously no equity. You don't get a tax break when you're renting. Again, as you pay down the loan, the balance, like I mentioned earlier, as you pay down the loan, the balance, your equity grows. Your home appreciating value increases your wealth. So as it appreciates, the property appreciate more, you're obviously building your wealth for the near future, like I stated earlier, for generations to come, where you might pass the house on to your relatives or whomever. But you're appreciating in your wealth. Let's see what else I got here. Always, when it comes to stability too, I want to talk a little bit about stability. When you're renting, there's always a threat of rent increase, future fees, and eviction if the landlord comes by and won't have a reason to want to question you about anything, which you don't have that problem if you own your own property, and your neighborhood constantly changing. But when you have ownership, your mortgage payment your payment, once you pay it off, it's done. So let's say you rent, you'll never stop paying. But once you pay that property off, then obviously you don't have a payment, other than you still have to pay real estate taxes. You still have to pay homeowners insurance, but you will no longer have a mortgage if you provide you have a property, or versus renting, because obviously renting, you still got a monthly payment, rent payment forever. But once you pay that mortgage off, you're done, other than taxes and insurance, which has to be paid annually as well.
James, one of the things that when most of us kind of grew up reading the Bible, hearing about the Bible, but the Bible always talking about you want to pass some wealth on to your family, something like that.
Exactly.
And I think home ownership is one way that you have something that the family, like you said before, that someone in the family, your kids can look forward to saying, Daddy or Mama left me something.
Exactly.
You have something to leave to somebody.
Well, and like you said in the Bible, it states you're worse than an infidel if you don't leave something for your kids' kids. So yeah, you want to have something you could pass on to the future, for the future kid generation. So yes, you're right. The Bible does state that. Let's see what else. I'm going to go over a few things. I just any questions about that one, Ira? Any?
No. You kind of got the Bible. When I was at the Bible, okay, but you kind of broke it down as what this required. Like it's a requirement that we do something. Okay, so you pass on something to your next generation. They kind of help them, in their lives and stuff.
Absolutely.
Help them out. Because most times, we always felt that we want to do better. Our kids should do better than their parents did.
Absolutely. We definitely want to pass on more than what our previous generation done for us, and to get hopefully the kids to get better and better each generation when it comes to wealth. One thing also, I want to go over the home buying process. Now, we talked about building equity and so forth, but I want to tell you the process of getting all this done to be in the property. The first process, obviously, is a pre-approval. I have a link that I refer people to, which is GillMortgage.com. Well, GillMortgage.com/James Gillespie. I'm sorry. That's GillMortgage.com/James Gillespie. So once I give that link out, I typically have the buyer go in and fill out an application on my link. If they do not prefer to do it, because some people are not really tech savvy, like myself, I'm not that great at the tech savvy thing sometimes, but if that's the case, I can take an application over the phone for them, as opposed to someone taking the application on my application link. Okay? But once they fill out that application, there's basic questions I need to know. How long you've been renting where you presently are, how long you've been on your present job, and then obviously they put in their social information so I can pull credit to determine if they can purchase the property based on whatever they want to purchase, because there's a debt ratio that we have to work with, and there's a certain amount that, for instance, FHA will, when I speak of debt ratio, FHA is typically 55%. Now, debt ratio means that if you gross an X amount of money versus your monthly bills, we want to know how much can you truly afford, or how much can you qualify, whether it's 100,000, 150,000, or 200. So it all depends on whatever you're making versus your bills. I had just this past week, I had a young lady. She wanted to qualify for, I think it was roughly about 300,000. But the problem was with her, she couldn't go that much because she had some student loans. Now, student loans, FHA will tell us that, I think her student loans might have been, I don't know, maybe $100,000 roughly, student loan, because sometimes student loans can get pretty hefty. But we as loan officers, we take 0.5%, and we use that as a monthly payment, as opposed to a larger payment. So 5% of 100,000, what's that? I think it's like $50, 0.5%. And so
I'm not good with math myself. I know I trust you on that one.
Yeah, 0.5 is $50. So we take $50 versus several other bills, and we determine that, like when I say other bills, that means credit cards, car payments, different things like that. And then we figure out how much you gross in a month. We go by gross, not net. A lot of people think when we qualify on a loan, we go by the net, what you bring home. We actually go by the total gross. That includes taxes, how much they take out of your tax. We go with the total gross. And so we take the total gross, and we take 55% of that, and we subtract the expenses out of the 55% of your gross. And at that time, and I say 55, that's FHA could go 55. If I went conventional, they typically only want to go 45%. But conventional also are looking for clients that has much higher credit score. FHA will go as low as 580 sometimes. So that's why I said 55%, because a lot of people doesn't have a 700 or 800 credit score, and so I go FHA because I can get you more house based on a higher debt ratio at 55%. as opposed to conventional at 45%. Okay, so that is another route that we go to determine that. Also, I mentioned earlier today when I was speaking with you, I stated that there's documents we need to get from a client, and those documents are W-2s for the last 2 years. 22, and if it was right now, we would get W-2s for 22 and 23. We also would get last 30 days of paycheck stubs, and then the last 2 months' most recent bank statement. Now, there are situations where a client may have a bankruptcy, and I will tell you this, FHA will allow you to purchase a property even if you had a bankruptcy after 2 years of being discharged from bankruptcy. And that's
James, one thing that you have said a couple of times, I need to clear that up. Today you was a guest on my radio program earlier today on Ferguson. Right. SouthTalkRadio.com. I launched with the Missouri Chamber of Commerce, program we've been on since 2015. And you was our guest today, okay, when you came on to kind of preview your show and tell us some things about the mortgage. That's when you referenced, okay, somebody said earlier that you gave an excellent report on how to buy a house as you're doing now. That's what you said. People say, what talk about that?
Yeah, I was on your show earlier today. Sorry about that.
Thank you again for coming on.
Yeah, I enjoyed that, and I just wanted to get more in depth since I was on your show for a short period of time. But I wanted to kind of go into details on my show here and explain the details of that. But and one thing I wanted to finish up, and thanks for sharing that with me, Ira, about being on your show earlier today. But I want to also finish that one point up about bankruptcy. If you're in a Chapter 7, if you had a bankruptcy and you've been discharged from a Chapter 7 for at least 2 years, you could qualify for a loan. Now, obviously, if it's less than 2 years, you cannot qualify. Conventional, they want you to be out of bankruptcy for 3 years, but FHA says 2 years. Now, there's two types of bankruptcy. There's Chapter 7 and there's a Chapter 13. You could qualify on a 13 with less than 2 years, providing that you get an approval. If you're still in it, you got to get an approval from your court, from the court, stating, say for instance on the 13, that's when you're making monthly payments. So let's say you owe $5,000 on your Chapter 13 left. You still got $5,000 left. The key is you have to go to the courts and say, courts, I want to purchase a property. I owe you $5,000 through my Chapter 13. Is that okay? And it's up to the courts to determine if that's okay for you to purchase a property if you're presently in the 13. Now, if you're in the 13 and the courts tell you no, then obviously you would have to wait until the Chapter 13 is completely paid off. But sometimes the judges will let you go ahead and purchase it, but they want you to pay them off first before you purchase the house, if you owe them, say, $5,000. Because remember, the 13 is the one that you make monthly payments on, and the 7 you do not have to make payments on the Chapter 7. So that's the one you do have to wait 2 years from discharge date. Okay? Yeah. So once we get all that information, and if there's anything else on the credit report, which we will see, if I need to get any other information, I will tell the buyer. But at that time, once we get all those documents, we run it through our what we call my loan committee. We send the file to my loan committee, which is the underwriter basically, and they're the ones to make the decision, the final decision, if the file will be approved. Now, before I send a file to the underwriter, I always eyeball it and make sure that I feel that it's a doable loan. I've been doing this for such a while that I have an idea what will work and what won't work. So I don't send files to the underwriter unless I have an idea that it'll get approved. If a file cannot be approved, what I typically do is advise the buyer what needs to be done. If they need to work on some credit issues, if they need to be on the job at least 2 years, you can't have let's say you were out of work for 6 months. If you've been out of work for at least 6 months and you start another job, obviously that's a 6-month gap. FHA doesn't like a 6-month gap. So that means if you've been out 6 months, you got to work for at least 2 years faithfully to be approved. So if you've been out of work less than 6 months and you go to another job, then you'll be okay to submit an application. But if you've been out over 6 months out of work, you got to wait till you've been working for at least 2 years. So that's another thing. Now, self-employed is different. Self-employed work, we would need tax returns for the last 2 years, 22 and 23. And so that we take an average based on the 2 years, because being self-employed, things fluctuate, business is up, business is down. So we take a 2-year average on the tax returns to determine how much a person has truly gross monthly if you're self-employed. Okay? And I'm working on a couple self-employed clients right now, and usually, even though they haven't filed taxes for the year 24 yet, which is obviously this year, we have them fill out what they call a profit and loss. A profit and loss consists of how much have you made in the last 8 months from January through August, how much money have you truly made, and what are the expenses that you had, and you could handwrite that, put it in a format, and send that to us as well, because you don't get a check because you're self-employed. Well, you get a check, right, but it's not a paycheck stub like or W-2. So
yeah. You own the business, you get paid last, unfortunately.
Absolutely. So we have the clients fill out a profit and loss form for the last 8 months. So if it's in August, well, I'll say July because this is August. So you do a profit and loss from January to July, and then we take that average and say, okay, this is how much money you make. These are your expenses, and this is how much you could qualify for. But again, if there's any issues credit-wise, any not long-term of work, I tell the buyers, I let them know that this is what you need to do to get prepared. I don't want them to think that they cannot purchase a house. It's just that you have to do your homework and do the things that I request, and you'll be able to purchase the house with no problem. So,
now, James, how long does that process normally take? I know it varies. Okay, well, in a normal situation, how long does that go from the time?
Typically, if I get all the documents from a buyer, in a timely manner, hopefully within 2 to 3 days or so, I could get a deal wrapped up in less than 30 days. So,
okay.
Yeah. But that's provided that the customer or the buyer is giving me everything that I requested. I have a team. I have a loan assistant. I have a processor. And once they start asking questions and needing certain documents, as long as the buyer give me all those documents in a timely manner, we should be able to close the deal within less than 30 days. Okay? Now, there are loans out there, such as the rehab loans, which is called a 203K for FHA, which is a rehab. Now, those loans may take 45 days because it's a little bit more involved. We got to get contractors out to find out what needs to be done, because the 203K, you buying it as it is, but you also requesting money to fix it up. So let's say you're buying it for $100,000, but you need $50,000 to fix up some things. So what happens? You have to have 2 contractors that go out and give us a bid on the work that needs to be done. And sometimes that might take a little bit before we get both bids back. And once we get both bids back and submit the file to the loan committee, it could take up to roughly 45 days. But if there's no work need to be done, it's a straight purchase, property's in good shape, we should be able to have it closed in 30 days or less. Okay? So.
Dan, I tell you what, Dan, we're going to take a little small break here, okay? You
Okay.
Catch your breath,
Okay.
And get your thoughts. But right now, you listen to, you say better than I can do what the name of your program is.
Gillespie, James Gillespie, the mortgage doctor. The name of the program, that's my name. I have, you know what, I want to put that together, and I'm going to name a good name for my program. I think I want to name it the mortgage doctor. That's it. James Gillespie, the mortgage doctor.
That's what you do, brother.
That's what I do. So I think that's a great title for my show. Yes, sir.
And on that note, Scott, we're gonna take a small break. We'll be right back with the mortgage doctor.
to.
Well, hello, Ira. We're back again. You there?
I'm still here, sir. We love again with James Gillespie, the mortgage doctor.
The mortgage doctor with James Gillespie. Yes, sir. I wanted to get to the second half of home buying process as well. I just went over the products as to what we need and what, and I know a lot of people may not understand FHA, but I want to explain what FHA is, before I move forward. FHA is a federal home authorized loan, which is owned by the government. And basically, FHA is for the government. It's a government loan, I guess I should say, but it's the term FHA, meaning that it says Federal Housing Administration. FHA, that's what it stands for. And so FHA was actually created back in 1934. It's been a while. But again, it's a loan that the government established for people that doesn't have the greatest credit, but not the lowest credit. And conventional are different types of loans. Those are loans that we want a higher credit score, but it's not owned by the government. It's a privately owned loan by investors, such as Fannie Mae. Fannie Mae is an investor that gives us the money to be able to give to the buyer. Fannie Mae is an investor that gives money to FHA, to conventional. So I want to kind of say that before I move on. But also, as I move on, I want to share this. After we've gotten this loan, after it's been reviewed by the loan committee and everything looks good and debt ratio is in good shape, then what the buyer does, I send them a pre-approval letter. Then what the buyer does is go out and hire a real estate agent, someone that can represent them in regards to finding a home. A lot of times, real estate agents have access to multiple listing of properties. We as loan officers, we do not. They typically do that because they're the ones that's out looking at these properties, as opposed to a person like me that sit in the office and prepare the numbers and get docs together in regards to getting approved for the actual loan. So you really have to hire you an agent. And I tell people all the time, if you don't have an agent, let me know. I have several relationships out there with different real estate agents that I can refer clients to that does a great job. Okay. And then once you're out there with your agent, then once you find the house that you really like, and that's the one for you, and a lot of people, they'll know once they walk into that property, they'll know, hey, this is the one I really, really want. Then you'll have your agent write up a contract. Typically, there's a buyer's agent and there's the listing agent. The listing agent is the one that is the representative of the seller of the property. So there's two agents involved. Typically, it's two agents. Now, sometimes the buyer's agent can be the listing agent just as well as both. It could be both. It could be both, the listing and the buyer's agent. But sometimes you have a listing agent and a buyer agent separate. But at the same time, once you like that house, you write the contract with your agent, and then they'll set up a commitment date. The commitment date is the date that you want to have your loan actually approved, and then there's a closing date. So let's say this is August. You write on the agent write on the contract that we need a commitment letter by September 10th, and we want to close by September 15th. So at my loan committee at Gill Mortgage, our job is to make sure that the appraisal comes back. We have to order an appraisal on the property. So if you're buying a $150,000 house, we got to order appraisal to make sure the value is truly worth $150,000. So we order appraisal, we look at all the docs, send the file to the underwriter for final approval, and we have to have that back by the 10th, September 10th, which is the commitment date. And then obviously after the 10th, then we prepare for the closing date, which is the 15th of September. If that's the day they pick. So, and then at that time, my closing department and the title company that the buyer's agent typically set it up with, different buyer's agents use different title companies. So if they come to me, if a buyer's agent write on the contract and state that they want to use, I don't know, Investors Title, whomever title company they like, then it's up to us at my company, my closing department, to talk to the title company, and put the numbers together. They put the closing costs together. They put all the numbers together. And at that time, within 24 to 48 hours prior to closing, we tell the buyer exactly how much money that they have to bring to closing, to the penny. And that's typically done 24 to 48 hours prior to closing. When you first take a loan, when you first apply for the loan, we do send out a loan estimate. A loan estimate states, well, this is how much you're purchasing, and roughly this is how much money you're going to bring to closing. We send that out within 3 days of the application. But before you close, you get the official one, which is the closing disclosure, and it states the exact to the penny how much you bring to closing. So we always have to give you an average. Now, back in 08, 09, that wasn't the case before Dodd and Franks came out. That was a compliance issue that came out that we didn't really have to tell the buyer what they were bringing to closing within 3 days, or estimate within 3 days. But they changed that, which is good, because now you cannot have a buyer come to closing and be unexpected as to how much money they were supposed to bring. If you tell them $1,000 and you're bringing in 2,000, then obviously that wasn't a good estimate. So we have.
Okay, let me ask you one question. Who sets the rules and regulations? Okay, I know to be an agent, you got to take a test. Who sets the guidelines for this whole process to go according to,
well,
things on that?
Dodd and Frank came out of let me look that up. That came from I'll tell you in just a minute. That came from give me a sec. Dodd and Frank is basically Dodd and Frank is a Consumer Protection Act, okay, which was established in 07, 08. So it's a legislation that passed in response to a financial industry behavior that led to a financial crisis in 07, 08. And it was actually signed by President Obama in 2010. Okay, so, right, but those are the act that was presented in 07, 08. I've been doing this since the 90s, and prior to 07, 08, that wasn't the case. And then obviously President Obama came in and determined that we need to be more specific as to what a buyer needs to bring to closing. Because, sometimes, people get upset. If you tell them $1,000 and they bringing in $2,000, that could be an issue. So, and if we're not, when we send out that loan estimate sheet, and if we're not close to that number, like if we exceed, I believe it's an eighth of a percentage of whatever the amount. If an eighth of 1,000, let's say eighth of 1,000. If I tell you 1,000 and I exceed an eighth of that, then we have to redisclose. We have to let the buyer know that, hey, we're off by eight, we're over by an eighth, and we have to redisclose and send those documents back out to you so you'll see that and you'll know a more accurate number. So years ago, you didn't have to do that, and I think it's better that we do that, because now nobody can't say they didn't know what they were bringing to closing. So I like I like that Consumer Protection Act that came out back then. It really has made it a lot easier, and people are not as frustrated about how much money they need to bring to closing. So that's been good. And go ahead. Did you have a question?
No. You answered that right there. You answered it right there. Right, yeah.
Good. And so once that contract is written, again, I was telling you that we send out disclosures once you submit the contract to us, my team, and then we send out disclosures within 24 hours so the buyer can sign. And once the buyer signs the disclosure stating that they're purchasing X amount of property, 123 Mockingbird Lane or wherever you're buying, once we send out the disclosure, the buyer signs it, and then that gives us intent to move forward. Once they sign it, they're giving us intent that, yes, we can move forward on this loan. We got to get an appraisal order, so we start the process. But until they sign that disclosure, we cannot move forward. So those are, when I say we can close within 30 days, these are the things that has to be signed. and buyer get me documents. As long as they get everything to me in a timely manner, we definitely could be closed less than 30 days. Okay. Also, buyers can have, they could do an inspection on their property, but the mortgage company, Gill Mortgage or any mortgage company, doesn't. It's not mandatory that you do an inspection, but you can. And I think most people want to do an inspection because they want to know what they're buying. They want to make sure that the furnace is in shape, to make sure that there's no water issues or termites or anything like that. So I think it's great to have an inspection, even though the mortgage company doesn't state that it's a requirement. Right.
Yeah.
So that's good. And the next step here, I'm looking at, like I said earlier, we have to order your appraisal. So if you're buying for 150 and the property comes in at 150, we're in good shape value wise. But if the property comes in at 140 and you wrote a contract for 150, then the buyer and the agent, the buyer and the buyer's agent, has to go back to the listing agent and negotiate whether the seller is willing to drop $10,000 in the sales price. And if the value is not what it was written for, then apparently the properties in that area is not going for 150. It's only going for 140. I'm just throwing a number up because I don't know exactly, the property, but giving you an idea. And if it comes in $10,000 less, then the buyer has to definitely, and the buyer's agent has to definitely go to the listing agent and say, hey, it only came in at 140, and are you willing to sell it for 140? And it's up to them whether they do that. But on an appraisal, on the FHA appraisal, the appraisal is stuck on that property for 6 months. So that means if it came in at 140 and you decide not to accept the 140 agreement, even though you wrote it for 150, no matter who buys or wants to purchase that house, that appraisal is good for 6 months. If another buyer comes to that property and say, hey, I want to buy, that seller has to honor that 140 because it's good for 6 months. They give you what they call a case number, FHA case number. And that case number is stuck on that property for 6 months. So either
that's for your protection. That's for your protection. Right.
Right. Either the seller accepts that or they got to wait till after 6 months and get a brand new appraisal. Now, conventional is not like that. Conventional, it's not stuck for 6 months on a conventional loan. And again, I don't know. I should tell you guys that it's 3 types of loans. You got FHA loan, which I just went over a little bit, and conventional loan, which is a private owned loan by the mortgage company. And then you have VA loan. VA is for the veterans. So, but on FHA, and I'm pretty sure VA the appraisal is stuck for at least 6 months, but not on conventional. Okay, so but yeah, so that's the thing. You got to get that appraisal done, and hopefully it comes in at whatever the sales price is. And again, if it comes in less, that could be a plus for the buyer. Because maybe they could purchase it for less than what they actually wrote the contract for, which could be a plus. And once the appraisal comes in and everything looks good, your loan is approved. We send the appraisal back to the loan committee, and the loan is approved by the underwriter. And then at that time, when I mentioned the closing date, which I stated September 15th, just throwing a date out, then on September 15th, you meet at the title company and you close. You sign your docs, and you bring, if need be, you bring a cashier's check made out to the title company if you have to bring any money to close. And we do have down payment assistance that we use. So we're able to offer some assistance money, and but sometimes you still may have to bring in, I don't know, who knows what it could be. It could be $500, it could be $1,000. All depends on how much money we can give you. But that is when, at closing, that is when you bring that cashier's check to the title company and get the deal wrapped up. And after you do that and close at the title company, obviously the agent is sitting there to give you your keys to your new property.
Yeah.
5 minutes, gentlemen.
The goal. Okay, that's 5 minutes ago, Mr.
Okay, I'm sorry.
All good.
Okay, well, go ahead. I'm sorry. Go ahead, Ira.
No, I did was saying 5 minutes ago. We just, started giving us a warning. Okay, so we want to get into an issue.
Okay. Well, yeah, I that's one portion, and I would like to get even further into it, but I know we only got 5 minutes. And on the next show, I'm going to continue to go down and talk about income, talk about assets. And again, I also want to talk about giving a definition of each one of these mortgage terms, because some people doesn't know all the terms, and I want to be able to explain each one of the terms and go over some more things. But I know we only got 5 minutes, and we will definitely adjourn to do it later, hopefully next week.
But I know, but it also, James, since one thing we've been talking about the conventional and also FHA, but you just mentioned the word veterans, the VA loan, next week. Okay, that's one thing we could possibly start off with. And we want to finish up the different type of loans that you kind of been very thoroughly broken down.
Yeah, we could go over VA loans, and we'll go over each one of them. FHA, and which I did kind of go over FHA today, but we're going to go over it more in depth. VA, FHA, VA, and conventional, because those are the only two. Well, we also have what we call the USDA loans. USDA loans, which is also a fourth type of loan. That's a loan for rural property, when you're purchasing property in a rural area as opposed to urban area. Okay? Now, and I'll say this before we wrap up. One thing about VA loan, they finance up to 100%. So if you're buying $100,000, you sales price, VA will finance you up to $100,000, the total amount. FHA finance you at 96.5. So that's, if it's $100,000 house, it's $96,500. But next week, and I know time is moving, we'll go into more in depth on how FHA, VA, conventional, and USDA loans work. Okay, but I wanted to kind of tell you the process, how we even get to that before we talk about the different types of loans. Okay.
Mr. Gillespie, it just amazes me how quick the time flies once we start to get off of it.
I know.
There are so many, different things, different caveats to it that, and that's something that people need to know, by the way. Not something
they need to know this. They definitely need to know it, because I always tell people, we lack. What's that come out of the Bible? It talks about. The
Bible says you lack because you ask not.
You ask not.
Lack of knowledge, you don't to perish.
Exactly.
That's why we're trying to be.
You will perish if you don't have this information. So it's always good to know, and the more you know, the better you're off. The better off you are. And the
name of our program here today, if we wrap it up, the name of the program.
The NARAP, what you say?
The name of the program today?
Oh, yeah. The name of my program is The Mortgage Doctor with James Gillespie. And I've enjoyed talking to everyone tonight. And again, if you need to reach me, my number is 314-369-8199. Again, 314-369-8199. 314-369-8199. If you have any questions, let me know. Give me a call. I'm here to help out as much as possible. Okay? So,
talk to you next week.
You bet. Thank you, Ira. I appreciate you.
Life is good. Be safe.
Life is good. Have a good one. All right. Bye-bye.